Your bonus hits your account at 2:17 a.m. The number is $240,000. Your base salary is $210,000. Total compensation this year, $450,000. 10 years ago, that number sounded impossible. Now it appears on a compensation statement and disappears into taxes, rent, and brokerage transfers before the week ends. It's 9:41 p.m. Your Bloomberg terminal is still open. You are a vice president at an investment bank. Your job is execution. Debt offerings, acquisitions, recapitalizations, transactions between $300 million and $2 billion. Analysts build the models. You run the process. Statistically, you are inside the top 1% of earners. Your apartment costs $6,500 a month. Your tax rate is roughly 45%. Your brokerage account recently crossed $1.8 million. To most people, the equation looks finished, but the first time you sit across from a private equity partner worth $80 million, the scale shifts. The meeting is about acquisition financing. Your bank will arrange the debt package, his fund will buy the company. You present the numbers. He studies the capital structure for 2 minutes, then he asks a single question about leverage tolerance. The meeting ends 10 minutes later. If the deal closes, the equity upside could reach $70 million. Your bank will collect $6 million in advisory and financing fees. Your share of that outcome is already determined. It will arrive next year as a bonus, calculated by a compensation committee you never meet. That's when the difference becomes obvious. Your income is large, but income is still linear. It arrives on payroll cycles, it stops when you stop, and it grows one promotion at a time. The people above you operate on a different curve. They don't optimize for salary. They optimize for ownership. And once you start noticing that difference, it appears everywhere. The senior partners talk about equity stakes. The private equity funds talk about carried interest. The investors talk about assets under management. No one at that level is discussing compensation. They are discussing positions. Because at the upper layers of the 1%, money is not something you earn. It is something you own. And the moment your investments begin producing meaningful returns on their own, your relationship with money changes. Your net worth crosses $5 million. For the first time, your capital starts generating income without your time. That is the moment you stop being just the earner. You become something else. You become the accumulator.
Your net worth crosses $5 million. The number appears gradually, not all at once. A combination of bonuses, equity compensation, market returns, and years of disciplined investing. At first, nothing changes. You still work the same hours. You still sit in the same office. You still answer emails at midnight. But the math begins to shift. Your investment accounts generate returns that are no longer trivial. A strong market year adds $600,000 to your portfolio. Some years, it adds more than your salary. For the first time, money begins producing meaningful money. You start paying closer attention to capital allocation. Index funds become too simple. You move into direct investments, private funds, and tax-efficient structures your private banker introduces you to. That conversation happens the year your assets cross $3 million. The bank assigns you a dedicated advisor, not because they value your relationship, but because your balance sheet now qualifies for their private client division. The language changes immediately. You stop hearing about retirement planning. You start hearing about portfolio construction, asset allocation, private credit funds, venture capital exposure, direct real estate partnerships. At this level, the objective is no longer income. The objective is compounding. You also notice something about the people around you. The conversations slowly shift away from careers. They move toward investments, ownership stakes, and deal flow. Someone you know becomes a limited partner in a venture fund. Another buys a small stake in a logistics company. A third participates in a real estate syndication, acquiring a $120 million industrial property. You begin seeing the next layer of wealth forming, not through salaries, through assets that grow while their owners sleep. Your job still produces your income, but your capital is beginning to produce something else, freedom. And the moment your investments begin generating seven-figure returns in a good year, you cross another invisible boundary. Because beyond this point, work becomes optional. You are no longer focused on accumulation alone. You begin looking for opportunities to deploy capital. That is when the next transformation begins. You stop behaving like an accumulator. You start thinking like the investor.
Your net worth passes $20 million. The number changes the way you evaluate time. Your portfolio now generates returns large enough to replace most professional salaries. A strong year in the markets can produce $2 or $3 million without requiring a single meeting or phone call. For the first time, work becomes optional, but something else replaces it: opportunity. You begin receiving invitations to participate in deals that never appear in public markets. A venture fund offers you an allocation in its next investment round. A real estate operator invites you into a private acquisition of a $300 million logistics portfolio. A former colleague launches a private credit fund and asks if you want to participate as a limited partner. These opportunities circulate through networks, not advertisements. The people presenting them are not looking for investors. They are looking for capital partners. Your role begins to change. You are no longer simply investing through funds and portfolios. You are participating in transactions. Some succeed, some fail, but the pattern becomes clear. The most meaningful returns do not come from the public markets. They come from ownership in private assets. And once you begin owning pieces of businesses instead of just shares of stocks, another shift happens. You stop thinking like an investor. You start thinking like the owner.
Your net worth crosses $100 million. At this level, you stop thinking in terms of portfolios. You think in terms of control. Owning shares of companies is no longer the objective. Owning significant stakes is. You participate in acquisitions instead of simply funding them. Private equity sponsors invite you to co-invest alongside their funds. Your capital helps purchase businesses valued at hundreds of millions of dollars. You now sit on boards. Quarterly meetings replace quarterly earnings calls. Instead of analyzing companies, you help decide their strategy, hiring executives, approving expansions, managing risk. The distance between capital and consequence becomes smaller. When revenue grows, you see it directly. When costs rise, you feel it immediately. Ownership creates a different kind of responsibility, but it also creates something else: scale. Because once your capital begins moving inside transactions measured in billions, your role shifts again. You stop thinking like an owner. You begin operating as the capital allocator.
Your net worth crosses $1 billion. At this scale, you no longer think about individual companies.
You think about capital flows.
Your wealth sits inside funds, holding companies, and structured vehicles designed to deploy billions across multiple sectors: infrastructure, energy, private equity, credit markets. You do not analyze individual balance sheets anymore. Teams do that. Your role is deciding where capital moves next. You meet with fund managers, sovereign wealth representatives, and institutional investors. Conversations revolve around deployment strategies measured in billions of dollars, not individual transactions. A decision to increase exposure to a sector can direct hundreds of millions toward it within months. Capital begins behaving like a current you help redirect. At this level, wealth stops being personal. It becomes institutional. Your capital participates in markets, industries, and governments at a scale most people never see. And eventually, another realization appears. Even billionaires are not the top layer. Above them are the people who design the structures that move capital itself. Those people operate as the architects. Your wealth is no longer measured by a personal net worth statement. It sits inside structures, trusts, family offices, holding companies spread across jurisdictions. Your capital is deployed through funds, institutions, and partnerships that move billions across borders. At this level, you rarely speak about individual deals.
You discuss allocation mandates, infrastructure programs, sovereign partnerships, multi-year capital commitments. Governments want investment. Pension funds want returns. Global markets require liquidity. Your role is deciding where large pools of capital will flow next. Those decisions shape industries long before the public notices. You are not trading in the market anymore. You are helping determine which markets receive capital in the first place. And once wealth reaches this layer, something becomes clear. The real power inside the 1% was never about salary or even net worth. It was about position inside the architecture of capital. Somewhere in a glass office tower, a young analyst opens a terminal for the first time. He believes this world is about money. He will eventually learn it is about structure.